Hi, good afternoon. My name is Chuck Morton, and on behalf of Venable and our panelists today, I'd like to welcome you to the third in our three-part series of webinars entitled Doing Government Contracting M&A Deals in Trying Times. Today's session will focus on financing, and we are joined by my partner, Diz Licaria, who assists government contractors and grant recipients in all aspects of doing business with the federal government. He's a partner in our government contracting practice group. And guest, Dr. Edward Bursoff, who's founder and chairman of Parabolis. Prior to organizing Parabolis, which is a company that provides asset-based financing to companies offering goods and services to the U.S. government, he was chairman and CEO of ATS Corporation, and earlier founded and served as chairman and CEO of BTG Inc., both publicly traded companies providing technical services in the public and private sectors. Also joining us includes Joshua Durman, who's Managing Director of Aerospace, Defense, and Government Services at Capital One, where he advises large corporate and middle market defense and government services companies in the areas of capital structure, syndications, senior debt facilities, debt capacity, acquisition financing, cash management, and other ancillary banking products. And finally, Jason Rigoli, who's a partner at Enlightened Capital, which provides both debt and equity financing, where he brings decades of experience in both operational roles and as a principal investor in the aerospace, defense, security, and government contracting industries. Prior to joining Enlightenment, he served as a principal and Washington, D.C. office lead for LLR Partners, a private equity firm where he led aerospace, defense, security, and government services related deal activity, in addition to a number of other impressive prior roles. He has served as the past president of the National Capital Chapter of the Association for Corporate Growth. So we're in for a treat. We have a terrific panel today, and my job is to try to facilitate a discussion among our panelists. But let's start, if we could, by inviting Diz to share some of his thoughts about what some of the unique issues we are facing today in the world of government contracting, given the array of things that are happening in the economy. Diz, is there anything unique in this environment?
There's a lot of things unique. First of all, thank you, Chuck, for inviting me, and thank you everybody for joining. And I'm honored to be part of such a great panel. With respect to this environment, there's a lot of things unique. Obviously. Much like, the commercial sector, the government is largely working from home. DOD is generally, working on site, but most agencies are working remote. And some aspects of DOD are working remotely as they try to decrease density. But, I think as the pandemic kind of started, the government a little bit hit the brakes on things, but has gotten back to government as usual to some degree. I think there's a fair amount of backlog that they're cleaning up, and there's also a fair amount of issues related to the CARES Act and some of the pandemic-related legislation that's been issued that's causing the government to, or at least take their attention away from the day-to-day business. We've heard that there's a fair amount of contract awards that are sitting on the sidelines right now and haven't been issued. That said, the end of the government fiscal year, it wraps up September 30. So all indications are, if they don't spend that money, they're going to lose that money. So they'll likely be issuing those awards over the next couple months, which will make for a very busy end of summer, early fall. But in terms of unique, certainly, working with the government in a remote environment has been a little bit of a challenge. I've had some odd experiences about the government people not wanting to look at documents that are over 10 pages electronically, and they want hard copies, but they don't have a printer. So there's some logistical things, but I think we've ironed out most of the issues, and things with the government are proceeding pretty much business as usual.
In terms of actual impacts of remote work on M&A activity, I think there was some concern that everything would come to a grinding halt. What are you seeing in the marketplace in real time?
Yeah, I mean, I think, again, I think that at the outset of the pandemic, there absolutely was kind of a grinding halt to a lot of things. As much like all of us trying to kind of reaccustom yourself or reacquaint yourselves with working from home, it took a little bit of, there were some growing pains there. And I do think that things slowed down on the government side because of that. But like all of us, I think they've gotten used to the working from home environment, and things are getting back on track. Obviously, like I said, the end of the fiscal year is just a couple months away, so things are going to be ramping up pretty significantly, I imagine, over the next couple months in order to get those contract awards out. So things seem to be coming back around, but there are things like novations, contract mods, awards that I mentioned that have definitely been delayed, and that's caused some consternation for the government community. And with respect to deals, novations, if you're dealing with a deal that requires a novation, that can be disconcerting to the buyer and the seller, that the novations are not processing as they would in normal circumstances.
It looks like there's another stimulus package that's in the works, and obviously this comes on the heel of a number of other things we've already mentioned, for example, the CARES Act. How are government contractors uniquely impacted by these efforts, if in fact they are?
I mean, I think they are. Like the CARES Act, they were eligible for, if they were eligible, they could participate in the PPP program. But there were also aspects of the CARES Act, like Section 3610, that was specifically addressed to government contractors, essentially saying that if your people were not able to work because of COVID and working from home, the government was going to still be reimbursing for their time and effort. So, you wouldn't have to lay those folks off. Again, kind of a stimulus unto itself. And so, the continuation of those programs will be key in this next package. There's, obviously they're going to be looking to continue the PPP program and other stimulus. So the government contractors absolutely have reason to benefit. I do think it bears mentioning the challenges that they have that is unique, which is, while you may be eligible for things like the PPP, if you're getting supplemental payments from the government from a separate program, that commingling and double dipping can be a problem too. So we've been advising lots of government contractors to be mindful of that, whether it's grants or contract funds that are coming in.
There were also certain certifications that needed to be made under the PPP that many government contractors really wrestled with. What are your thoughts about how that went, and what did you see with the initial waves of PPP applications?
Yeah, it's a great question. And as you well know, Chuck, the outset of the PPP program was quite hectic at Venable, and as I imagine with lots of firms, as clients were clamoring to see whether they were eligible. And eligibility required a number of different things, but one aspect required compliance with the affiliation rules. Well, one thing that I would say the government contractors had a leg up was that they're very accustomed to the affiliation rules. The affiliation rules for small business is something that has been around for a long time. It's slightly different under the PPP program than it is under the traditional small business test. But by and large, the concepts were not new to government contractors. So I think that was actually something that benefited government contractors because they were more accustomed to that kind of paradigm. But there were a number of certifications, and the guidance, unfortunately, was changing daily at times to where it really left all businesses, government contractors, but all businesses really in limbo with respect to how to count employees, how to determine how much you were eligible for, all those types of things, the need, whether there was a financial need for this money. There were all sorts of questions coming out of the PPP program and the continually changing guidance that really caused some consternation. So hopefully the rollout or the continuation of the program under this new stimulus that's being kicked around will be a little bit smoother than last time.
And just on a macro level, where do we stand in terms of the forgiveness process under the PPP? Obviously, billions of dollars were doled out. Most borrowers hope or expect that their loans will be forgiven. Where are we in that arc of time?
Well, I think we're still, that first program, the 8 weeks of it has since expired. And I've not had anyone apply for forgiveness yet personally. But, I think the audits are coming, as was well, chronicled. There were going to be a significant number of audits for organizations that received over $2 million. And I think there'll be some, there's going to need to be some degree of audit for everybody to see whether or not the loan was forgivable. So I think, unfortunately, just based on my experience of how government audits work and how any cost issues are analyzed and processed by the government, it could take several months or years for that to unfold. So I think we're maybe at the beginning now, Chuck, but I would imagine it will take quite a while for this to completely resolve itself.
I think that's probably a pretty safe bet. Let's open up the discussion a little bit, and let's start by making certain that our audience has a clear understanding of how our various panelists fit into this picture. Jason, why don't we start with you, and if you could describe a little bit about how Enlightenment fits into the world of financing government contracting, M&A, and firms more generally.
Sure, thank you. Chuck, thank you very much for including me on this panel, and many thanks to Kelsey for handling all the logistics. I appreciate the opportunity to speak to folks. So my firm, Enlightenment Capital, is a lower middle market focused private investment firm. We are investing exclusively in the aerospace, defense, and government services market. We've been around since 2012. We're over 30 investments into our track record. We have 11 active portfolio companies. We're investing out of 4 different private equity and private credit funds. And we have invested in and supported companies that are pursuing M&A growth through a number of different structures. We have served as a lender and a debt provider in a number of circumstances. We also provide minority equity, if that is a better approach and an approach that businesses that we are seeking to partner with would prefer. And then in some instances, we're also the control investor, where we own, collectively greater than 51% of the equity ownership of the combined business after effecting our investment in the M&A transaction. And if you look at our 11 active portfolio companies today, 4 are control investments, and then the remainder are a mix of either debt and or minority equity. And we are, I think we're unique in that we are not dogmatic or extremely, kind of structured in how we look at deals. Every individual investment really is unique. It's got its own attributes. It's got its own structure. The lower middle market of the government services sector has a lot of nuance to it, and you have to be flexible in how you allocate capital to avoid things like affiliation or jeopardizing small business set-aside programs or any of those types of issues. But just about every business we invest in is looking to grow beyond the small business set-aside domain. They're generally $100 million of revenue or less when we start, and the goal is to help grow them north of $100 million and preferably north of $200 million, and mature their operations and their infrastructure and their business development capabilities so that they can compete on a full and open basis as an agile mid-tier prime contractor. And so we've been doing this for a while. Some of our notable exits as of late include firms like Phase One, Vistronics, Aurora Flight Sciences, but again, we've exited almost 20 investments, so we've got a good number of others behind that.
That's great. Joshua, folks are obviously familiar with Cap One as a large financial institution. Perhaps you could speak a little bit to the way in which you focus on the government contracting space in particular.
Yeah, thank you so much for having me and inviting me to speak, and an honor to be a part of the panel. So I'm a managing director on the Aerospace Defense and Government Services team for Capital One, and really we're part of the commercial bank and are primarily a senior lender. I've been with Capital One for almost 6 years. I was with Citibank for a couple years prior to that, and with Bank of America for about 10 years. Prior to that, with most of my career really being focused on providing senior debt to the government services sector. So the way that we're structured within Capital One, we're considered a vertical. So we work with founder-led, private equity-backed, and large corporates. And really, we're primarily financing M&A transactions, again, for sponsor, non-sponsor, and public clients across the board in the defense and government services sector. And our clients really appreciate the broad perspective that we can bring them, because we really do speak to the entire market and are able to help, just like Jason was discussing, clients that are looking to grow from small business to full and open, or the obviously larger clients looking to do a add-on acquisition as well. So just really cover the entire market from that perspective.
And Ed, from Parabolis's perspective and your broader perspective, having led 2 public companies and grown one up entirely as the founder, where does Parabolis fit into this mosaic of funding sources for government contracting companies?
Sure, thanks, Chuck. Parabolis was founded as an alternative to lenders that were not providing capital to or financing to government contractors. Companies that were either had some issues with their balance sheets, their P&L, essentially companies that were not bankable. Companies that had served those kind of clients before us were kind of predatory in their practices in many cases, and we decided that there was a spot for a lender who was more understanding of the companies that we financed. So given our background and our CEO and other members of our staff have actually worked in government contracting companies, so given our understanding of the market, we created Parabolis to serve those needs. So we're primarily an asset-based lender. We have well over 50 clients over the years. We founded in 2013. We have more than $70 million of loans outstanding. Now, we have both asset-based loans as well as term loans or cash flow loans. Cash flow loans are typically trying to get these companies more stable if they've already had a loan that was called by a bank or other kind of lender, or even potentially companies that have had issues with the IRS. But more lately, we've been dealing with cash flow lending for companies that are trying to make an acquisition where banks would not be willing to finance it. So we are in that space where companies can now come to another source, slightly more expensive, obviously, than bank financing, but we're at least there with some capital that they can use to grow their businesses.
Terrific. And I should invite members of the audience to submit questions if you would like. There's a feature on the tool that we're using to facilitate that. I'll do my best to monitor them and try to weave them into our discussions. And also want to point out a little bit of the context for this particular series. We at Venable were talking amongst members of our corporate group in May about areas where we expected to continue to see deal activity, and government contracting was certainly one of those areas as a place that we thought in the middle of the pandemic there could be ongoing activity. In these 3 sessions, we've had more than 1,000 people register to sit in on them. The first one was focused on valuations in the middle of these trying times. The second one was all about deal execution, and this focusing on financing. But it certainly highlights that this is an area where there's a great deal of interest for folks. And I'm curious, Jason, why don't we again start with you about whether you think that government contracting could be a uniquely or at least a particularly attractive area during times of economic uncertainty.
Sure. Yeah, thanks. So I'll talk about kind of more recent times, but I also think it's important to note how the industry performed during the, kind of the Great Recession of the 2008 timeframe. The U.S., kind of writ large was clearly struggling, but the Washington, D.C. regional economy was the best performing regional economy during that period, and it was on the backs of government contracting. And in the public markets, defense and government services-based publicly traded businesses performed better than any other market segment at that point in time as well. So you can use that as sort of a general guideline to how well the industry holds up during macroeconomic challenges. And this, particular kind of COVID-related issue, it's a little bit unique because you don't necessarily have economic issues driving the challenges. You've got a health and kind of an overwhelming kind of virus that is creating situations where folks can't access their work facilities, and in the case of government contracting, sometimes that includes secure government facilities, and there are programs, particularly in classified client communities, that just don't work well in the work-from-home type environment. So, in this particular kind of situation, there have been some areas where the nuance of the government services industry, particularly in the intelligence community, has created a bit of challenges with regard to being able to support those customers. Now, the good news is most government agencies have embraced the CARES Act 3610 billing, and so they recognize that they don't want the contractor workforce to leave the government services industry and go work for commercial industry, go work for Amazon or Microsoft or someone else, and so they've told contractors, keep paying your folks and keep covering their fringe benefits, but and we'll reimburse you for that, but don't charge us fee on those dollars. And so there is some help that is specifically focused on the government services segment that's benefiting some of these government contractors. There's a lot of considerations when you bill CARES Act. If you have already accepted PPP financing, some agencies have kind of indicated that if you have, you cannot seek CARES Act billing, and so you've got to be careful around issues related to double dipping, for lack of a better term. But once again, the industry is coming out of a broader economic issue way better situated than just about any other industry segment in the U.S. And again, the intelligence community is probably the only area where there's been any meaningful impact, and those agencies have addressed the issue with the 3610 billing. So we're in pretty good shape across the entire industry segment. And so we as a private equity firm and folks that have a host of investors, and those investors are big insurance companies and university endowments and pension funds, and they those investors have investments in a number of different industry segments. We have heard over and over again from that investor universe that we are their best performing assets, and that they are amazed at how well our government contracting portfolio has held up in light of the other challenges across the country that are driven by the COVID issue.
Joshua, within Cap 1, are you finding that you are being favorably compared in a similar way to other parts of the bank that may be serving parts of the economy that have been impacted more seriously?
Thanks, Chuck. The short answer is yes, but I can unpack that a little bit. And first, I can talk a little bit about just general deal activity. I spoke with our partners at Kips DeSanto yesterday just to get an update on their view as well. Obviously, they're sort of on the front end of the M&A deal flow, and they continue to have a bullish outlook for the sector for the rest of the year. They closed 10 transactions year to date, 8 since March 1st in the middle of COVID, which compares to 20 for 2019. And then on the financing side, on the commercial and corporate banking side, we've been incredibly busy in our group. This year alone, we've closed on 2 new leverage buyouts, 2 investment-grade bonds, a high-yield bond, 3 add-ons for mid-tiers. Some of that was pre-COVID, but quite a few of those were actually in the middle of the pandemic. So really, from a credit perspective, we see the sector as a bit of a port in the storm. The industry just hasn't been as impacted as some of the other industries that we cover broadly throughout the bank. There are still impacts to the credit markets, which serve this space, and I'm sure we'll talk about that in a little bit more detail as we move forward in the conversation. But the way we're looking at it, really the resilient and predictable cash flows from the companies make this sector certainly attractive, even in relatively uncertain times. And the revenue visibility created by the long-term contracts obviously helps us underwrite those transactions. So we continue to be busy even in the middle of the pandemic.
That certainly is consistent with what we're seeing at Venable. We have nearly 90 corporate lawyers from coast to coast, and while the government contracting part of our M&A practice is always robust, it's been disproportionately so since March, just because there's been less of a serious impact on those deals than many other deals that have ground to a halt, not really picked up momentum. Ed, in your specialty finance practice, I would presume that one of the reasons you're interested in the space is because of the recurring revenue, long-term contracts, and the things that Joshua just pointed out. Are you continuing to feel confident about that in the middle of otherwise uncertain times?
Yes, yes and no, actually. So I hate to be a bit of a downer here, but we talk a lot to the CEOs of smaller companies. Our typical client is $100 million or less. And there's a schizophrenia going on. Yes, right now in this budget year, there's a lot of positives. The momentum is still great, and as was already pointed out, year-end money is flowing and will flow through the end of the year, so budgets aren't cut and people don't lose their funding. But I think that by and large, the government contracting community, especially in the smallish size, even though there may not be small businesses, but both small businesses and medium-sized businesses, they're running scared about what's going to happen next year and the year thereafter. We're facing huge deficits, and no one argues with the benefit of the expenses that are going on, or the spending that's going on, but what is going to be the impact of budgets for next year and the year thereafter to this community? So for the moment, unlike other crises, other crisis periods when government shutdowns impacted the contractors, I say we, but the government contractor community has been less severely hit. As it was pointed out by Jason, I think that the only real impact has been in the intelligence world, where you can't really go to your customer sites on a regular basis, but even those folks have been taken care of. So I think there's a lot of M&A activity, in part because many of the companies, especially the targets, are a bit scared of what might happen in the next year or two. So that's creating a demand. Larger companies are trying to find targets so that they're more stable as life goes on, and the smaller companies are looking to be acquired because they're afraid of what's going to happen in the next couple of years.
So some of us who are of a certain age appreciate that prior to the 2008 downturn, there certainly in the DC area was not the sense that government contractors could weather every storm and never be battered by the ups and downs of economic cycles, particularly government spending. But some of us can remember government contractors experiencing their own version of boom and bust cycles, but it does seem that the cycles of economic downturns evolve over time. And Ed, let's go back to you. How would you compare this economic downturn to others that you have seen in the course of your career, in particular as it relates to government contractors?
Well, I think, as was pointed out before, this community, I think the worst time for this community was actually in the dot-com bubble when there was work to be done but no people to do it because they were fleeing to the siren song of the dot-com world. I think that has stabilized over the years, but we faced a severe personnel shortage in 99, 2000, 2001 period until that all sorted itself out. But with respect to economic downturns, I think that our community is counter-cyclical. We don't seem to be hurt particularly. We're more vulnerable to interest rate ups and downs than we are to the other cycles, I think, and we tend to fare well unless there's a period like a government shutdown where there's kind of layoffs and angst among the contractors. So we tend to do well, and we're doing well now, as was pointed out, but the worst time is when budgets get cut and there's less work to be done. And as I say, I think we see that coming. It came obviously after the wall came down in the 80s, late 80s and 90s, and there was a down cycle then, obviously, but we got through all that, and I think we'll probably get through this as well. But right now, there's a lot of fear.
And Joshua, how about your perspective on this particular moment in time compared to other challenges that have faced the community?
Thanks, Chuck. Thanks for the question. I would say in almost all previous downturns, banks played a significant role. However, in this economic downturn, banks are really focused on providing government stimulus and working with clients who've been impacted through really no fault of their own by the shutdown driven by COVID-19. So it's unique in that way. During this economic downturn, banks are really well capitalized at this point in the cycle. So there's little risk associated with banks right now. But more specifically from an ADG or a government services perspective, if you look at the Great Recession of 2008, as I think Jason had pointed out, government services companies were not as impacted during that downturn as some of the other industries, as the government tends to actually continue to spend during an economic, or even increase spending during an economic downturn. It really wasn't until the budget caps and sequestration came into play in 2013 that this market really saw a hit. And I'm sure that will play out again in some form or fashion in the next few years, but that's really the way we're looking at it.
We're joined by, I can tell only because I can see the attendee list, a number of investment bankers. So at the risk of stepping on their toes, Jason, I'm curious to hear from your perspective. Let's start with you, where you are seeing active deals in the government contracting space.
Well, to be honest with you, we're seeing it, all over, and with, roughly the same consistency we saw, pre-COVID. So there are no industry segments that we have seen that have really kind of spiked from a deal activity perspective. You could suspect maybe in the future, contracts that were let through maybe some of the more healthcare-oriented agencies to address the COVID risk, and maybe even contracts that will be let to deal with all of these PPP audits that will need to be done by somebody at some point in the future, will generate opportunities for some government services businesses. But all in all, the deal activity, the types of deals in the industry segments where we're seeing deals have not changed materially. And so it's all pretty consistent. We've closed, during the COVID crisis, we've closed 2 platform investments, and knock on wood, we're hoping to close a tuck-in acquisition here by the end of the week. So we've been actively deploying capital, and where we have seen changes and adjustments has been in the financing markets. Okay, so while we can provide debt and/or equity, oftentimes we pursue deals that are large enough that we seek third-party debt to support them. And in those markets, we definitely have seen a decent degree of constraint and kind of pullback. But it's changed weekly. I mean, we saw a severe amount of pullback in the early days of COVID, and it has since sort of eased up a bit. But there's still a decent degree of caution, and that means less credit available, less liquidity in the market to support M&A, and that should, in normally efficient markets, have an impact on on valuations going forward. We're also seeing a little bit of an odd dynamic from a tax perspective. Folks that were waiting to sell their businesses are now trying to read the tea leaves and see what might happen to the tax laws should there be a change of administration. And there's a pretty commonly thought assumption that if there is a change of administration, the tax treatment of capital gains and other tax elements that layer into kind of sale proceeds could increase. And we saw this in previous administration changes as well, where you have a race to get a deal closed before the end of the calendar year, because it looks like the tax rates would increase such that even if your business grew by 20% the following year, you still wouldn't get the same proceeds you would if you sold today. And so we're starting to see a fair amount of that dialogue as of late. And so there may be a mad rush by the end of the year with a number of folks trying to exit businesses before any potential tax change. But it's hard to read the tea leaves on some of that stuff, and all of that is just speculation at this point.
But so I was having that discussion earlier today with a GovCon seller, and when you look at the tax proposals that have been floated from the Biden camp, some of the proposed changes at least are awfully dramatic and really invite those sorts of questions. But in terms of where we're seeing active deals and perhaps the changes in financing, Ed, what are you seeing at your place in the market?
Well, one of the
things we're still. Oh, I'm sorry. You said Ed. I apologize. Didn't mean to jump.
Yeah, no.
It's okay. So one of the things we're actually seeing is deals that are not purely cash deals. It takes something of a seller to have faith in the acquirer, but in some cases, we were seeing deals that are both equity as well as cash changing hands. So Company A would provide some ownership in the target company that's being acquired. That puts less pressure on the cash portion of the deal, and in some cases you can see a deal without any cash at all, and then it's not so much the absolute valuation, because sellers tend to think that their value is higher than the buyer thinks the value is. In this case, when there's no cash involved, it's a little bit easier. When both companies, you can do a relative valuation and figure out what the metrics are. But the availability of cash from mainstream lenders is, I think, a little bit more constrained than I'm hearing right now. I think that you have to be a really solid buyer if you're going to get bank financing, and so companies are looking for alternatives to grow their businesses and make the acquisitions that they see possible.
You mentioned earlier, Ed, that you thought that perhaps it was a tale almost of two cities, that on the lower end of the market, there was one appetite. As you get larger, things change. Obviously, that's always the case to a certain extent, but in this market, are you seeing that to be more acute than usual? And where are the lines naturally drawn?
Well, I'm not sure I follow the question, but the smaller companies, especially those. I mean, if you're a small business and you're involved with small business set-asides, your you're really in tough shape at this point. No one's going to be acquiring you because they're worried about novation of contracts that was talked about before. So you have to be out of that area. You have to be in the full and open world, or at least moving in that direction before you're even attractive. But buyers are looking to diversify. I think it's really interesting to see that buyers who are heavily in defense and aerospace are interested in the civilian agencies to kind of hedge their bets and vice versa. So it's kind of interesting time where people are not intensifying the markets that they're in, but they're trying to diversify their markets.
Are you seeing new market entrants come into the government contracting space because it's, relatively speaking, more attractive than other verticals? And if so, is that beginning to impact the market at all?
I think it's very hard for a non-government company to enter the market directly. That either they would want to be acquired, or they just try and don't make it, because it's a unique world, and they don't like the rules and regulations. They don't understand the FAR, and it's not something that's comfortable for them. So I think the uniqueness of the government marketplace protects us from outside predators who are trying to enter it. There's a few exceptions, of course, but by and large, I think that's the case.
And Joshua, is that your assessment as well, or do you see anybody coming into the government contracting space just opportunistically trying to find yield in a less risky asset class?
I would agree with Ed. We don't see that very often, certainly on the corporate side. We have, over probably the last 18 months, seen more interest from private equity firms that maybe aren't pure play aerospace, defense, and government services. But I would say in large part, we really haven't seen folks that are on the commercial side try to move into the federal sector. However, when I think about sort of the active deals that we've been looking at over the last several months through COVID, we continue to see deal activity, founder-led companies, similar to kind of what Ed was talking about, looking for diversification, but also looking to accelerate, out of small business and looking for an add-on acquisition that would help propel them out of that. Private equity firms, certainly those that are really focused on the space, are flush with cash and looking for new platforms and add-on acquisitions, and we've been working with them. And then you saw a number of the I would just call them mega deals that happened in the first quarter, kind of pre-COVID, Leidos buying Dynetics and the L3 Harris piece, and SAIC buying Unisys Federal. And we helped with all of those as well. And so you had a lot of momentum in the space going into the pandemic. And I think a lot of that momentum has just sort of carried through, although I would say at the beginning of the pandemic, the traditional sort of term loan B market wasn't functioning as well as the high yield bond market. And really, the bond market was functioning because of support from Congress, or the pro rata bank market on the lower end, which tends to be less volatile, be a less volatile market in general. Therefore, we saw more opportunity for companies to look to the traditional pro rata bank market. Really, willing to sacrifice the flexibility they could have in the term loan B market for the lower cost of capital and certainty of execution in the bank market. That seems to have softened somewhat over the past few weeks, where the term loan B market has definitely strengthened. But that's really sort of the ebbs and flows of the market we've seen kind of through the pandemic, specific to this sector.
Joshua, you heard both Ed and Jason suggest that there had been some contraction of access to debt. Do you think that's now behind us, or if you had a crystal ball, what would you anticipate, at least for the next couple of months in terms of access to debt to fund deals for government contractors?
I think I don't know that I would say it's been restricted. I'd say it's just potentially a slightly higher bar. And terms and pricing and things of that nature have shifted. But I would say for companies that are that were functioning well going into the pandemic, that are looking for M&A transactions, there's capital there for them. It's just a matter of again, just being maybe a higher bar than it was prior to.
What are you seeing, Joshua, in terms of pricing and other terms of in the market for the types of facilities you were just discussing?
So yeah, terms have definitely tightened. Leverage has come down broadly. I mean, when you think about just the market in general, obviously certain industries are heavily impacted, and so that cascades into government contracting, even if the market, our market, really isn't as impacted. We've seen the institution for most pro rata deals now. We've seen the institution of or reinstitution of LIBOR floors, kind of in the 50 to 100 basis point range, and it seems like pricing across the board in the pro rata bank market has gone up, anywhere from 25 to 100 basis points. And certainly, we also, especially on the private equity side, compete against a number of direct lenders, and the pricing there in that market has gone up substantially, well over 100 basis points. I think back to what I was saying before, that both the rated term loan B market and the sort of non-rated stretch senior market has strengthened a little bit over the last couple of weeks, but that is still an area of the market that's probably been the most strained through this whole pandemic.
And Ed, what are you seeing from your vantage point?
Well, it would be really nice if we could deal with strong companies that had the access to bank financing. Our clients don't fit that category, and for them, pricing is very, very high and oftentimes unavailable. So if you're a struggling company, and I don't mean companies that are at the edge of disaster, but companies that are have low margins and maybe have some balance sheet issues, the availability of capital at any reasonable price is kind of just not there, non-existent. So there are people like us who come along and provide some access, but we too are not going to lend to folks that are not creditworthy to a totally extent. I think some of the government programs that, like the Main Street Lending Program, were designed perhaps to fill that void and get the banks comfortable because the government would buy these loans. But as a practical matter, they just don't work. And it turns out you're probably better off if you qualify for a Main Street loan. You're probably going to qualify for a bank loan. So bottom line is we deal with companies that have issues, and we try to provide them with some degree of access to capital, debt financing, but it's going to cost double digits in terms of pricing.
And Jason, you guys at Enlightenment occupy the space of being both a debt and equity provider. Mm-hmm. What are you seeing in terms of terms and cost of capital in deals that you're looking at?
Sure, yeah, and we have been in the market during this kind of COVID challenge, so we've got some real-time data. I mean, look, if you are below $10 million in EBITDA, most commercial banks will lend up to about 2.5 times your EBITDA. And to Joshua's point, the cost of that capital is going to be kind of 0.5% to 1% more expensive than it was pre-COVID, and there'll be some floors on the rates because LIBOR is so low. If you want to access the non-bank lending market, then you might be able to get kind of 3.5 to 4.5 times EBITDA, but that cost of capital will likely be twice what the bank would charge. If a bank's going to charge 5 or 6%, you're going to pay a non-bank lender, kind of 10 to 12%. And then if you're north of, 20 million of EBITDA, then the bank lenders can certainly lean in and kind of step up and, lend, into the threes and maybe close to 4 times EBITDA. And the non-bank lenders can do, kind of 5-ish plus, maybe even 6. But again, the cost of capital in both of those lending universes has increased as a result of COVID. But pre-COVID, the non-bank lenders, you were seeing very, very low terms. You were seeing single-digit interest rates, and you were seeing 7x leverage ratios, which wasn't uncommon. And one would argue, the markets were probably a little overheated when you were seeing those types of terms. So I wouldn't say that was a rational point to be, and I wouldn't say where we are today is a rational point to be, but, somewhere in the middle, will likely be where we settle out here before too long, and that's probably the right place for the market to be.
Where do you see the leverage ratios heading?
I think again, it's different based on EBITDA, but for businesses that are north of 20 million of EBITDA that are seeking debt, from a bank, they'll probably be able to get 3.5 or 4 times. And if they look to a non-bank direct lender, they probably can get 5 and, might even be able to get close to 6. But that money will be more expensive.
It feels a little bit like Back to the Future, right? The pendulum does swing. Jason, Ed earlier mentioned some deal structures, for example, all equity deals. What are you seeing in terms of non-traditional deal structures? So rather than just a traditional leverage buyout fueled by a PE fund, what do you see coming to market? And what are people doing to get deals closed?
Yeah, if there's less debt capital available to support a deal, then it creates a hole in the capital stack needed to close the deal. And you can fill it a number of different ways. The sellers can roll over more equity to fill that gap. They can take a seller note, which would be kind of another piece of debt, but it would be subordinated to the senior lenders. We're seeing earn-out structures, to help kind of bridge that gap as well. So, there are a host of tools that can be used to bridge that gap, and we're seeing all of those tools being used creatively right now.
Ed, are there other structures that you could anticipate seeing?
No, I think that we just heard kind of the gamut. Yeah. And each has its own strengths and weaknesses. Earnouts are difficult if it's based on profitability because it's hard to measure that. But payouts or seller debt financing is pretty common. So yeah, I think those are all mentioned. But I want to just add to the comments about financing and that we were just talking about. What do you do if you're an $80 million company with $5 million of EBITDA? Those are the companies that we're looking at, or a $50 million company with $2.5 million of EBITDA, and you want to grow your business. None of the banks or even the private equity firms that I know of are interested in that world. That's kind of where we focus. But if you're in that category, it's a difficult time to get traditional financing at any reasonable rates. And so, what do you do if that's your situation, other than wait 2 years and grow your EBITDA? So that's a dilemma for companies of that size.
Absolutely. Let's shift gears just a little bit. Jason already alluded to this a little bit, but why don't we go to Joshua? Joshua, how do you see this election cycle impacting M&A for the balance of the year? In a typical election year, there would have been way more attention placed on the election, and given all of the other things that are happening, there just has not been quite as much this year. But an election is coming, and what are your thoughts about how it may impact M&A activity for the balance of 2020?
I would see, or I would imagine that we see more deals get launched in late summer, just trying to get ahead of the election. because of the uncertainty that it causes. I completely agree with you. I think our attention has been on the pandemic, and therefore folks haven't been as focused on sort of the other areas that really affect our market, which include budget deficits and elections. And I don't think there's been much focus on those with respect to the M&A process at this point. And I think, again, speaking with the folks at Kips DeSanto, it sounded like they anticipate more deal activity in the second half as things really kind of pick up. It seems like there was a bit of a whipsaw where, in early March, many of the deals slowed. Certainly some of the things closed, but everything seems to be picking up a little bit more now. So I think we would see an acceleration of deals getting launched, hopefully prior to the election.
And you've successfully exited a couple of times. What's your thought about a deal that's kicking off in August, about the probability of being able to get that closed before the end of the year?
Well, if everybody's motivated to do it, it can happen. My first company, when I sold in the 80s, in 2001, actually, we started the deal before 9/11 and ended the deal soon after 9/11. Those are really tragic times, but deals can be done if everybody's motivated to do them. So I think if everybody's got the deal in mind, top of mind, it's going to happen. I do think that, as I said before, sellers are a bit fearful about what will happen budget-wise in the next couple of years, and they're also worried about tax increases, which are probably inevitable no matter who wins the election. But that will probably prompt deals to close sooner rather than later.
Let's spend a minute or two just trying to unpack these giant deficits. And Ed, I'll stick with you on this point, given your last comments. You've been in this community for a very long time. What's your expectation about what is likely to happen with government spending in the face of these enormous deficits?
Well, it's hard to be a seer in these, looking at the government, because they behave bizarrely in almost all cases. But I think, again, a change of administration would probably lean to more funding in the civilian agencies to help people who are distressed because of COVID as we come out of it after there's a vaccine, which means there's going to be pressure on aerospace and defense, I believe. At the same time, we have security issues that are huge, national security issues, cyber attacks, and all that. So there's going to be, I think, spending that has to go into those areas. So, if there's only one group left, and that's the military, who might see issues with their funding. But it's pretty clear to me that the budgets, the traditional budget cycles, the traditional budget climates are going to be reduced, and there'll be some winners in certain cases and some real losers. And so I think that's probably why people are trying to diversify, just to hedge their bets.
Jason, from Enlightenment's perspective, is that a fair assessment of what's likely to happen, and what are you guys doing to try to rationally position yourself for these anticipated changes?
Yeah, I mean, look, our underlying assumption is that we can't keep spending the way we're spending. When that slows and how that slows and how that adjusts is just simply unknown. So we try to have a pretty broad portfolio of businesses that we're invested in, and we do help the portfolio companies that we're invested in also diversify themselves. And as Ed said, you try and focus them on areas where the threat profile is driving spending. The Chinese and the Russians don't care if we're going through a recession. They're going to keep hacking our government agencies and our critical infrastructure, and so we've got to spend there. That's the new arms race, and for better or worse, we've got to be allocating capital there. But the budgetary line items with a whole lot of zeros behind them are going to be at the top of the list to attack. And so you can see personnel costs and you can see reduction in force type efforts within the military and some of the bigger agencies, including the Department of Defense. You can see key weapon system programs like the F-35 could potentially see pressure or a slowing in spending because they are such big budgetary items. But we try, again, to Ed's point, we can't be seers and we don't have a crystal ball, but we try and focus on those areas where logically the spending has to occur. And we don't know all those pockets, but we know many of them, and that's where we try to direct our investing attention and direct our portfolio companies.
And when you think of diversification, share with us, if you would please, what that means to you. Sometimes people simply mean get bigger. Sometimes people mean build out business lines and disparate areas. What does diversification mean for you in this context?
Well, yeah, I mean, and so if you're talking about portfolio company diversification, then it's definitely a push into adjacent service areas and adjacent customers as best you possibly can. And so if you are primarily supporting, let's say the NSA, then a move into the Air Force Cyber Command makes sense, and you might be able to find your way into cyber initiatives and some of the other intelligence agencies. And you're still concentrated in, kind of highly classified customers or the IC, but you're on multiple programs with different funding sources. And so it gives you a little bit more of an opportunity to weather storms. We're generally not huge advocates of, primarily intelligence-focused businesses jumping into civil agencies because it's easier to work from home in civil agencies. That logic doesn't make sense. We tend to try and expand the adjacencies as opposed to any, major shift in strategy that's not currently part of the core business.
And Joshua, for your customers, as they try to grow, are they thinking about diversification the same way that Jason is, or are they thinking about it in a different way?
I think it's a little bit of both. It depends on what part of the market. So in a number of the private equity firms we work with in the space that have new platforms, it is usually adding on a company that has either access to a broad range of IDIQ vehicles that they feel they can capitalize on, or a set of capabilities that they think they can expand that are in relatively adjacent markets. You've also seen, like I mentioned before, some of the large corporates go into large transactions in sectors where they have some expertise but are looking to really build out their capabilities in space or C4ISR in a really big way. From an underwriting perspective, we love diversification. It helps us really feel that those cash flows are resilient, so that if the funding from one agency or one area is reduced, that it can be picked up by another. I mean, I think that's just good business sense sort of across the board.
There have been, yeah.
I was going to say the companies.
I'm sorry, go ahead.
The companies that are looking to expand their capabilities in adjacent markets, I think, are a normal and natural way to look to diversify the business.
Yeah. So we mentioned this a little bit at the top of our conversation and some throughout, but there have been a whole series of government financing vehicles from the PPP to Main Street. And obviously we're all just sort of drinking from a fire hose and learning as the details of these programs continue to both be teased out and also the implications of them understood better. I'm curious, let's start with you, Ed, about how you've seen any of these programs impact the work that you're doing, if at all. So in some instances, I think it's been a little bit of a red herring, but how have these programs impacted your business?
Well, actually, the programs, especially PPP and 3610, I guess, are really helping the companies we work with, and so companies that were struggling financially were able to keep their employees, get them paid. In some cases, in many cases, get the employees stay on board and paid through some of the PPP loans, for example. So they're stronger now than they were before, and they're able to use that money. They use the money in the appropriate way, but that frees up money for other things, and they're paying off some loans and doing it all properly. But I think they end up being very much stronger as a result. The only issue is, and I think this was alluded to earlier, we just don't know all the rules and regulations. It's complicated, and a lot of people are fearful of doing the wrong thing and getting into trouble and not having their loans forgiven or whatever penalties there might be. So, the government money does not come free and clear and without concern. But bottom line, though, is if it's properly done, these mechanisms have actually made our client base a lot stronger than they were when we started.
Joshua, what have you seen from the vantage point of Cap One?
So the PPP program was obviously a massive effort internally for Capital One to stand up the program rapidly, be able to support our clients broadly. More specifically within our group, we haven't seen the same demand for PPP loans or Main Street lending loans as other parts of the bank. Going back to, I think that many of the companies we work with just weren't impacted to the same extent potentially as other folks within the sector. I think a lot of it has to do with their ability to work from home, 3610, a number of the things we've already talked about today.
And Jason, from the perspective of an investor, but also someone who has portfolio companies, what's been your experience with these various programs?
Yeah, so, right out of the gate, a couple of our portfolio companies where we were a minority equity owner or a lender with minority equity, we had a couple businesses in that early on in that very first round successfully secure PPP. And then as the additional guidance came out, we just decided to give it back because it was unclear exactly how the audits would work, and that whole 3610 billing concept was starting to develop, and so we saw a better path for those businesses. So we took it and then gave it back really quickly. On the other side, we have had private equity funds who have gotten into trouble in some government-oriented portfolio companies, and they can't access the PPP program because of affiliation issues. They've sought our investment through our SBA-licensed SBIC fund because once an SBIC fund invests in a private equity-backed portfolio company, it severs that affiliation issue, and it's a little bit of a legally nuanced issue, but the net is it enabled them to seek and secure PPP, and so we've supported some sponsors in that area as well.
That was when it became clear that SBICs could decouple the affiliation. There's sort of a mad rush in some circles around that. But let's close with just asking each of you, and I'll start with you, Jason. We've got a number of attendees on the line who, if I had to guess, look like they're business owners. And let me just ask you for one piece of advice to share with them if they're looking to finance a purchase or to finance some growth initiative. What at this moment in time would you encourage them to be thinking about? And I'm going to ask the same of both Joshua and Ed.
Yeah, I mean, so when we look at these opportunities, we certainly look for, a handful of key attributes. And first and foremost, we assess the management team and want to make sure that they're a backable team and that they have the ability to integrate the acquisition and run a much bigger enterprise. And so to the degree that you can have executives within your team that have experience running bigger businesses and have been through the M&A integration process, that's helpful. Then we look at the underlying financial characteristics of both businesses, and so it's really important to just have your books and records in order and be able to answer revenue and earnings-based questions relatively quickly and efficiently. And then we look at the logic behind the deal as well. Is there a likely scenario where 1 + 1 will equal more than 2, where the combined business can go out and pursue new work that they would not have been able to pursue had they not acquired this other company? And and to the degree that you can walk us through how that might materialize, that's very helpful in getting us to a point where we have conviction in the deal as well.
Joshua, same question to you.
So I would echo really a lot of what Jason had said. Management is key, in having experience in M&A transactions is vital when you're looking at financing one of these transactions. Some other things that we look at just from a risk perspective is recompete risk over the near term. If you're looking to grow your business from a small business to full and open, really what does that transition plan look like? And what concentration, if any, do you have? Kind of what is, we talked about this before, what level of diversification do you have in the business today, and what will that acquisition bring? And finally, you asked for a piece of advice. I would say just really open and honest communication around all of that. And because at the end of the day, your financing parties are going to be the ones that really both help you close your deal, but certainly in a bank, from a bank perspective, it's going to be a relationship you have for a longer period. So you really want to make sure that you continue to have really open and honest communication throughout that entire process.
And Ed, last to you.
So it's not always good to be last in those, because those are all very good points. I would just simply say that look for quality. You're not going to save your company by making an acquisition. This is not about looking for a way out. It's about building your business and building a business with a right partner. So the money will come if the deal makes sense. And as I say, just search for quality, and I think that's the important aspect that you need to focus on.
Terrific. So on behalf of Venable, let me thank each of you for participating as panelists, and let me thank you, the audience, for joining us today for Doing Government Contracting M&A Deals in Trying Times. This is the third of a three-part series focused on M&A activity for government contractors, and hopefully you have enjoyed it. Today, we were joined by Diz Lucaria, who's a partner in Venable's Government Contracting Practice Group, and Dr. Edward Bursoff, who's founder and chairman of Parabolis, Joshua Dearman, who's managing director of Aerospace, Defense, and Government Services at Cap One, and Jason Rowley, a partner at Enlightenment Capital. Gentlemen, thank you very much for your insights. This has been Chuck Morton, head of the corporate group at Venable, and we appreciate your time. Thank you.